In this tutorial, I'm going to demonstrate MyECFO's portfolio risk assessment tool, which you can access by going to any browser and typing in allocation.myecfo.com. So the way to use this tool is you have four parameters that you need to enter. You enter the amount that you wish to invest, and you can make up that number. Let's just say we're going to invest $1 million. And then you're asked to enter the percentage that you would have in stocks, bonds, and cash. Again, stocks are the riskiest, cash are the least riskiest categories of investments. And so you can get a sense of what the risk profile is going to be. So you can start playing around with, say, 50% stocks, 40% bonds, and 10% cash. Now, it's important that the three numbers that you enter add up to 100, and you will know that because these bars are lighted in green, so you're good to go there. At the bottom, it shows you the amount that you invested: 500,000 in stocks, 400,000 in bonds, and 10%, 100,000 in cash. And at the bottom are the results of this analysis. So you have the portfolio allocation, a nice bar chart here, what it looks like. The two tables, or the two figures that I want to point out are most important when thinking about portfolio risk, are the worst annual returns and the worst ending values. So the worst annual returns provides a table that gives that looks at historical data, 1929 to 2013, of U.S. stock returns, bond returns, and treasury bill returns for cash, and tells you what the return would have been on an annual basis. So here we see that your portfolio in a worst case scenario would have given you about minus 22.7% in a 1 year period. But what's interesting is that in a 30-year period, if you could hold on for 30 years, and this doesn't take into account fees and taxes, but it gives you a sense of what happens in a 30-year period, would be around 6% a year. Now that is the worst absolute return over that nearly 100 years of what would have taken place. So the name of the game is to hold on as much as possible. As you can see, that the amount that you would lose per year goes down significantly the longer you hold on to your investment portfolio. Another way to think about it is, what would have been the worst ending value of your initial $1 million investment? You can see in a 1 year period you would have ended up with $773,000. But if you were able to hold on 30 years, again not taking into account taxes and fees, you could have ended up with about $5.6 million. So name of the game, wait as long as possible, and you'll be, or should be, fine, and based on historical data. No one knows what's going to happen in the future, but that's based on historical information. The other piece, average and best annual returns, are given here. The average ending values, the best ending values. Good to know that in 30 years, your $1 million would have ended up with about $24 million in the best case scenario. As I like to emphasize to my clients, the most important parameters to look at are the worst case scenarios, because the best case and the average case, most people will be happy with. But it's when things go really bad that there is concern. So this has been a tutorial on portfolio risk assessment tool. Again, you can access that tool by allocation.myecfo.com. You can reset the parameters by doing this, and I hope you enjoy it.